In this video, we're going to be completing Comprehensive Problem 8-1. Our taxpayer is Trish Hempel, and she owns Hempel Retail, and we have her information here regarding her sales and her expenses. So we're going to be completing a Schedule C for her business, and we'll spend a lot of time calculating the depreciation for her assets. We're provided a book basis fixed asset roll forward by her bookkeeper, and we're going to use that to calculate the depreciation for 2024. She earned wages, so she also has a W-2, and she has a home office. So we will be completing the 8829 to calculate her home office expense. We are not going to be completing the Form 1040 because the problem does not ask for the 1040. We're just going to be completing Schedule C, the 8829 for the home office expense, the 4562 for the depreciation, and the Schedule SE for the self-employment. So we will not be completing the 1040 or the Schedule 1. Of course, if we were actually going to totally complete the tax return, we would have to transfer all these figures over to the 1040 and to the Schedule 1. So let's just get started with Schedule C. Okay, so I've started completing the top portion of Schedule C for Trish. We've got her name and social security number, her business or profession, the code from the instructions that best identifies her business or profession. The business name is Hempel Retail, and her employer ID numbers here with her business address. It said in the narrative that she uses the cash basis of accounting. She did materially participate in the operation of the business, so we'll click yes. It was not started in 2024, so we won't click here. She did make payments where she would have to complete a Form 1099, and she's saying that she did complete those. So we'll start with the gross receipts from the business. The information we need for the Schedule C is here in the narrative, so we will just transfer these figures over to the appropriate line on Schedule C. The gross receipts were given as $345,000. There were some returns and allowances, which reduce the amount of the gross receipts. So if we subtract the returns from the gross receipts, we'll get $331,000. Now we need to calculate the cost of goods sold, and we have to do that over on page 2, starting in part 3. The method of inventory we're going to mark as cost, and there was no change in determining the inventory valuation. So the beginning inventory was listed in the narrative at $87,000, and she purchased $100,000 more in inventory. There was no cost of labor, so we're going to add lines 35 through 39 and get $187,000. This is the total goods that she had available to sell in her retail store, what she started with plus what she purchased. Her inventory at the end of the year was $72,000. So if she had $187,000 available and only $72,000 is left at the end of the year, that means her cost, the cost of what she sold, or her cost of goods sold, was $115,000. So we will move this $115,000 from line 42 to the cost of goods sold line. And the gross profit is $216,000. So her net sales were $331,000. The cost of those sales were $115,000. So her profit is $216,000. There was no other income, so we'll just bring the $216,000 down to line 7. Her advertising was reported at $6,000. Then we've got, we're going to skip depreciation. We've got a long calculation for that, so we'll come back to line 13. Line 15, insurance, was $2,500. Rent for other business property was $24,000. Her supplies were $800. Taxes and licenses were $5,000, and utilities were $2,000. Legal and professional services were $5,000, and wages were $59,000. So over in the narrative, we're going to take a look at that depreciation schedule that her bookkeeper provided. Okay, so here is a list of her assets. She purchased some in 2022, some in 2023, and here are her 2024 purchases. The depreciation has been calculated, but notice it is for the straight line method. This is her depreciation for the book basis. We need the depreciation using the Modified Accelerated Cost Recovery System, or MACRS. In the narrative, it said that for her 2022 and 2023 assets, she did not use the bonus depreciation or the Section 179 expense option. She just calculated the MACRS depreciation using the depreciation tables. So that's what we're going to have to do for her year 3 depreciation here and her year 2 depreciation for the 2023 assets. For the 2024 assets, she did opt to use the bonus depreciation. So let's move over to this spreadsheet where I can show you some of those calculations. So we have our cost basis, and I've just moved that over. And we'll start with the 2022 asset. We've only got one, it's a cash register. So we need the depreciation for year 3. That's 22 was year 1, 23 was year 2, so 24 is going to be year 3. It has a 5-year useful life. So we're going to come down to the depreciation for personal property, assuming a half-year convention. Now, most items that you depreciate that are not real property or rental real estate are going to be depreciated using Table 8.2 or this half-year convention. So we have a 5-year property. The recovery year is 3 for the cash register. So the percentage is 19.2%. So the basis of 9,500 times 19.2% gives us depreciation for 2024 of $1,824. Now we'll move to the 2023 assets. We've got one for $5,500, that's a 7-year item, and one for $4,200, that is a 7-year item. Now what you have to watch here are the acquisition dates. Notice that the furniture was acquired in the last quarter of the year, and MACRS requires that we use the mid-quarter convention if over 40% of the assets acquired were acquired in the fourth quarter. So we have a total of 9,700. 4,200 was acquired in October, which is in that fourth, October, November, December, the fourth quarter. So that is if I take 4,200 and divide that by 9,700, that's 43%. So over 40% of the assets were added in the fourth quarter. So we're going to have to go down and use the mid-quarter convention. The first item, better get that figure first. The first item was purchased in June. That is the second quarter. January, February, March is the first quarter. April, May, June is the second quarter. So June 21st for $5,500, and it has a 7-year useful life. So I'm going to go down to the table that has the mid-quarter convention. Okay, the second quarter, recovery year 2. 2023 was year 1, 2024 is year 2. I'm coming over to the 7-year column, and so 23.47 is going to be the rate that we're depreciating it times the 5,500 basis will give us $1,290.85. The second item for 2023 was purchased in the fourth quarter, so I'm going to go down to the mid-quarter table, and for under fourth quarter, recovery year 2, I'm going to go over to 7 years, and 27.55 is the rate, times the 4,200 gives me depreciation of $1157.10. Now the 2024 additions are going to take a little more time to calculate. They were all purchased on June 1st. So the first thing we're going to do is follow the instructions and take the bonus depreciation. The bonus depreciation for 2024 is 60%. That means we can take 60% and go ahead and expense 60% of the cost of these assets with the bonus depreciation. So I'll take the 38,000 times 60% gives me a depreciation expense deduction of 22,800. The 11,000 times the 60% is 6,600. And then 3,000 times the 60% is 1,800. So all that can go ahead and be depreciated. Now there's some basis left. This item costs $38,000. We're only taking expense of $22,008. So we've got a basis of $15,200 remaining to depreciate. So I'm going to go to the table 8.2 because we are not using the mid-quarter this time because everything was acquired in the second quarter. So we're going to go down under 5-year. Recovery year 1 is 20%. So the remaining basis times 20% gives me more depreciation of $3,040. The desk and cabinetry had a basis of 11. We took an expense of $6,600, which leaves a basis of $4,400. This is a 7-year item, year 1 recovery. So 14.29 is the rate that we're going to depreciate the 4,400 remaining basis. So we get a depreciation deduction of $628.76. The last item has a 5-year life. So that's year 1 is 20%. The remaining basis is $1,200. That's the $3,000 minus the $1,800 bonus depreciation times the 20% is $240. So now we can add up all the depreciation along with the bonus depreciation to get our total. So 1824 plus the 1290 plus the 1157.10 plus the bonus depreciation of 22.8, 6600 and 1800 plus the 3040, the 628.76 and the 240. And when we add that all together, we get $39,380.71. Now we'll use the information from our spreadsheet to complete Form 4562. This is the form where we show the details for the depreciation. Now Part 1 is for Section 179 deductions. We did not have any Section 179 deductions, so we're going to skip that. If we did, we would list the property here and then how much we elect to deduct and then total that and then bring the total down to line 12. We do have a special depreciation allowance, which is the bonus depreciation, and that's going to show up here on line 14. So we need to go over to our spreadsheet and add up these three bonus depreciations so that we can put that on line 14. 22.8 plus 6,600 plus 1,800 is 31,200. So on line 14, the bonus depreciation is entered at 31,200. Now line 17 is for depreciation for assets placed in service in tax years before 2024. Okay, so that includes the depreciation for the 2022 and the 2023 assets. So 1824, the 1290.85 and the 1157.10 equal $4,272 if I round that off. Okay, so keep in mind if you are calculating depreciation on items that were not purchased in 2024, the lump sum goes on line 17. Now for the new items, we've got to come down here and enter the specific information for each item. Okay, we'll start, we know we have some 5-year items purchased in 2024. This is just for the 2024 acquisitions. We'll start with the 2 5-year items. We've got 2, the basis is 15,200 and then the computer is 1,200. If we add those two together, then our basis is 16,400. So on the 5-year item here, the basis is 16,400. The recovery period is 5 years. The convention, we'll put HY for the half year. And the method is 200% declining balance. If you haven't had accounting 1105, you might not be sure or really know what declining balance is, but you'll find out once you take financial accounting 2. So the depreciation deduction for both of those assets were 3040 and 240. So that's going to be 3280. We had one 7-year item. The 7-year item has a remaining basis of 4,400. It was a 7-year item with the half year 200 declining balance. So on the 7-year line, we'll enter the 4,400 basis, the 7-year recovery period. We're going to use the half-year convention there, 200 declining balance, and the depreciation was 629. So now we have all of our depreciation entered, and we're going to bring the bonus depreciation, the depreciation on the items placed in service before 24, and then the depreciation on the new items down to line 22. And we'll enter 39,381. Now this 39,381 is going to come over to the Schedule C on line 13. Now we can finish up our Schedule C. Line 28 asks us to add all our expenses from line 8 to 27B. And when we add those, we get 143,681. If we subtract that from our gross income, our tentative profit is $72,319,000. Next is line 30, which reports the expenses for the business use of your home, which means we need to attach Form 8929, so we need to begin completing that so we can calculate our home office deduction. The first question is the area used regularly and exclusively for business. So if we go back over and look at our assignment, it said that Trish uses 250 square foot of her home. Her home has a total of 2,000 square foot. Okay, so the area used for business is 250. The total area was 2,000. If we divide 250 by 2,000, that's going to be 12.5% of her home that she uses for business purposes. So we will skip lines 4, 5, and 6 there for daycare facilities. We'll just bring our percentage down. On line 8, it says to enter the amount from Schedule C, line 29. Schedule C, line 29 was just the company's profit. So we'll enter the $72,319. And then we're just going to go ahead and bring that down to line 15, because none of the lines in between apply to us. Now on lines 16 through 23 asks for the home expenses, and we're going to allocate these home expenses partially to the home office, and then of course the other part will be personal. So we need to go back and see what those are. The problem said that utilities were $3,200, cleaning $1,200, insurance $1,800, and property taxes were $5,000. Also, while we're here, we'll see that the purchase price of the home was $200,000 and the market value is $250,000. We're going to need that later on. So let's get our expenses in. We had real estate taxes of $5,000, insurance of $1,800, Repairs and maintenance, $1,200. Utilities, $3,200. And the total expenses on line 23 will be $11,200. In 24, we're going to multiply the $11,200 by the percentage of business use. So 12.5% of $11,200 is $1,400. There's no carryover, so we'll bring that over to line 26. Line 27 asks us for the allowable operating expenses. Enter the smaller of line 15 or 26, and 26 is the smaller. Your home office deduction cannot exceed the profit from your business, so that's the reason they're asking for that. Then line 28 wants us to subtract line 27 from 15. So when we take 72,319 and subtract 1,400, we get 70,919. Now, this is the maximum we can take for casualty losses and depreciation. So we don't have any casualty losses, so we're going to skip line 29, and we're going to calculate the depreciation on the home office. So to do that, it says we need to go to line 42 below. So we'll start to complete part 3 here. Enter the smaller of your home's adjusted basis, that was $200,000, or its fair market value, $250,000. So we're going to put the lower of the two, $200,000. There was no value of the land included, so our basis that we're going to be working with for the depreciation is $200,000. The business basis is we're going to multiply line 39 times line 7, that was the 12.5%. So 200,000 times 12.5% equals 25,000. Now we need to include the depreciation percentage. So you were provided with depreciation tables for residential real property and non-residential real property. Though it is a personal residence, it was used for business purposes. So we're going to use the 39-year non-residential real property table. It was purchased in 2019, and we were not told the month it was placed in service, but that doesn't really matter. Recovery year 2 through 39 is 2.564 for every month. So that's the percentage that we're going to use, 2.564. So when we multiply the 2.564% times the 25,000, our depreciation deduction is $641. And we're going to take the $641 and bring it up to line 30. And then we'll just bring it to line 32. And I need to enter the smaller of 28 or 32. So once again, our deduction for depreciation cannot exceed the remaining profit after we entered the expenses for the home office. So line 33 will just be 641. For line 34, we're just told to add line 14, 27, and 33. So there's nothing on 14, 27, and 33. So the total will be $2,000 There's no casualty loss, so the total allowable expenses that will go on the Schedule C is the $2,041. So the expenses for the business use of the home will be $2,041. Now we could use the simplified method, but using the simplified method will give you a much smaller number. It's the square footage of the part of the home used for business, which would be 250 times $5. So 250 times 5, that would only be a $1,250 deduction, and the 2,041 is much higher. Once we deduct the home office expenses from our tentative profit, we will get $7,278. Now, we were told not to complete Schedule 1, so we will not be moving anything to Schedule 1, but we are going to complete the Schedule SE. We'll take our profit over to line 2 of the SE. Okay, so line 2 is the $70,278 from Schedule C. We'll bring that on down because there's nothing on lines 1A or B. In line 4A, we multiply line 3 times 92.35%, and we'll get 64,902. 4B does not apply, so 4C will be the 64,902. We don't have any church employee income, so we'll move the figure down to line 6. And then we will go over to 8A. We need to report total Social Security wages and tips. That's the boxes 3 and 7 on the W-2. If it's 168.6 or more, we've got to skip lines A, B through 10 and go to line 11. So let's go back over and check out the W-2 that she had. Okay, so her wages, tips, and other compensation is $115,000. So on line 8A, we'll put $115,000. And then we'll bring that down to 8D because that's all of her earned income where she paid Social Security. Line 9, we are to subtract 8D from line 7. That'll give us 53,600. We're going to multiply the smaller of line 6 or 9 by 12.4%. So when we take the 53,600, that's the amount that she has to go before she exceeds the wage limit, we'll get $6,646. Social Security has an earnings limit of 168.6. So after a taxpayer reaches that threshold, they no longer have to pay Social Security. So she has already paid, she and her employer have paid Social Security on the $115,000. So she only owes Social Security on the remaining $53,600, not the entire $64,902 of her self-employment, because some of it has gone over the threshold. Now we're going to calculate the Medicare, and we're going to multiply line 6 by 2.9%. Medicare doesn't have a threshold. So you'll pay Medicare no matter how much you make. On line 12, we're going to add 10 and 11 and get our total FICA taxes, Social Security and Medicare. They're actually self-employment taxes because it's both sides. It's the employer and the employee side. Normally we would move this figure over to Schedule 2. We do not have to fill out the Schedule 2. So we are just going to calculate our deduction now. So if we were filling out the Schedule 1, we would carry this deduction over to Schedule 1 and it would be a 4 AGI deduction. So half of the 8528 would be 4264. Of all the schedules we've worked on in this video, for your Chapter 8 exam, make sure you are familiar with the 4562. This is where the depreciation is, of course, reported. Remember, line 14 is for bonus depreciation. Line 17 is for assets placed in service in tax years before 2024. And then all assets placed in service during 2024 should be somewhere here on line 19, depending on their useful lives.